Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be covering dividend stocks. Ask yourself, are you looking to add some new stocks to your dividend portfolio? Well, you've came to the right place. We're going to be covering 5 of the best dividend stocks going ex-dividend next week, October the 22nd through the 26th, 2018. I have 5 stocks for you guys this week. Ticker symbol APOG. This is Apache Enterprise. This is the industrial goods sector. We have FAST, ticker symbol FAST. This is Fastenelco. Their sector is industrial goods. We have ticker symbol LKFM. This is Lakeland Financial. They're, of course, in the financial sector. We have Lowe, ticker symbol LOW. This is Lowe's Companies. They're in the sector of services. And then we have THO. This is Thorn Industries. Their sector is services as well. So those are going to be the 5 stocks we're going to be covering in today's video. These stocks have been screened for all having dividend yields greater than 1.5%. They all have had rising revenue, net income, free cash flow, positive over the last 5 and 10 years. Their forward PE is expected to be less than its current PE, meaning that their next year's earnings per share are expected to grow. They're expected to grow their revenue, continue growing their company as a whole, and they've grown their dividends for at least the last 5 years or longer. I believe one of them stocks this week, Lowe's, has been paying out dividends for some 40-some years. So very good list here of stocks. So if you are getting started in your investment journey, I do recommend checking out M1 Finance. If you're looking to open up a Roth IRA, I just made a video covering the differences between a Roth IRA and a taxable account, and you're basically getting double the income you would get out of a taxable account when you go to retire. And I kind of came up with a plan there. I also have a free app available on the Google Play Store. It's a very simple dividend calculator. I'm going to be making my second app here, coming up with a simple retirement calculator, and that'll be here releasing very soon. So all of these stocks are ordered by ex-dividend dates, October 22nd through the 26th, 2018. The number beside them has nothing to do with, the rank or so on. So if you are brand new to the channel, I do make stock market, personal finance, real estate investment videos weekly. So consider subscribing for future videos, and let's go ahead and get into it. Number 1, we have ticker symbol APOG. This is Apache Enterprises. They engage in the design and development of glass products, services, and systems. The company operates in 2 segments: agriculture products and services, and large-scale optical technologies. Their stock is going ex-dividend on the 22nd of October. That is next Monday. You would have to buy this stock on Friday or prior to be eligible for that dividend payout on the 7th of November. This company here, this is their 10-year trend, so their price is up 259.4% over the last 10 years. Their net income here in the green is up 50.34, and the red we have their free cash flow, and in the orange we have their revenue. So if you were to take their 10-year average here, if you were to take their 10-year increase and divide it by the number of years as the chart is 10 years, so their price goes up on average 25.9%. In the red we have their free cash flow up 9.9%, net income 5%, and their revenue up 4.5% on average per year. So pretty good growth there as far as the company goes. Now here, this is their 1-year chart. So Apache, it pays out roughly almost 16 cents per share. They just raised it here not too long ago, back in January. They pay out right around 16 cents per share each quarter per share. They're currently priced at $39.17 or somewhere within that range. That gives them a current yield of 1.61%. Depending on the day, if the stock moves up, the yield is going to go lower. If the stock goes down, the yield's going to go higher. Currently, the yield is sitting above the price. Here, their current PE is at a 13.7, forward PE is at a 12.49. The price to book is at a 2.04, and their price to sales is at a 0.79. So when charted, it does show this current stock does have a higher yield of a price, which may indicate it could be undervalued at this time. The stock is also trading below the industry average of 17.9 and below the S&P 500 PE average of 22.46. The S&P 500 has recently taken a hit, and it came down roughly 3 PE, price to earnings by about 3 just within the last week or so. This stock is sitting below the 60% payout ratio. It's sitting at a 19.7 payout ratio, and it's had dividend growth for the past 6 years. This price to book is at a 2.04, which is below that 3.0 value, where value investors would consider it a value. Again, current dividend is sitting, or current yield is around a 1.56, 1.61, just depending on the day. They pay out roughly 63 cents per share each year, or about 16 cents per share each quarter. Payout ratio, again, 19.7, and they've grown their dividend for the last 6 years, just raising it at an average increase of 8.41. From the year 2012, they did freeze their dividend. So the reason here that they've been raising it since 2012 is during the downturn of 08 through 2012, they did freeze their dividend. They froze it in place, so they were paying out like 6 or 7 cents per share, and they just kind of froze it out, locked it out during this downturn. So they didn't cut it, such as other stocks out there, like General Electric or so, but they just kind of froze it out. They want to continue keeping their shareholders happy and paying out that dividend. Number 2, we have Lowe's. Lowe's is a home improvement retailer chain in North America. It operates over 1,500 stores. Lowe's serves homeowners, renters, and commercial business customers. It is the second largest hardware chain worldwide, right behind Home Depot. This stock is going ex-dividend on Tuesday, the 23rd of October, so you'd have to buy this one on Monday or prior to take advantage of that payout date on the 7th of November. This stock here, these are all 10-year, so their price is up 446% over the last 10 years. That's an average return of 44.6%. That's just the price. That's not including that dividend payout. Here in the red, we have their free cash flow up 257%. In the green, their net income up 61%. And in the orange, we have their revenue up 45%. If you take these numbers divided by 10, that will give you your average increase, year over year increase on average. Here, taking a look at their 1-year graph, they have they're now paying out 48 cents per share, raising it from nearly 40 cents per share. That's a very nice increase there. So 40 to 48 cents, that is a very nice increase. Here you can see that their dividend growth on average is around 31.5% for the past 10 years. They're currently priced at $104.67. Their current yield is around 1.83. This is because that hike. This payout is their first payout at their new dividend payout. They used to be paying out 40 by 4, that's $1.60. They bumped it up to $1.92 per share each year. That's a very nice increase there. So, doesn't quite put them, it puts them more in that valued area. I expect this company, due to that downturn that we just had like the last week, this is a great, in my opinion, I think it's a great buying opportunity. Lowe's, we're going to continue here. Current PE is at a 21.94. Forward PE is at a 20.21. In the green, we have their price to book, which is at a 14.63. Price to sales is at a 1.22. This is in that, what sector was it in? It was in the services sector. So, price to sales is probably a little bit more important than a price to book. So when charted, it just showed the current stock does have a slightly price over yield, which may indicate it could be overvalued at this time, but I would say it's more about that flat level just due to that increase in yield, putting it at a fairly valued state. The stock is trading slightly below the industry average of 22.2. It's currently trading at a 21.94, and it's also below the S&P 500 PE average of 22.46. The current stock is trading below the 60% payout ratio at a 37% payout, meaning that if they were to lose half of their earnings, they can continue to pay out to their shareholders and still have money in their earnings per share to be able to just continue to raise and be able to support themselves. They've been able to continue to grow and raise their dividend for the past 55 years since 1963. So they are very recession proof. Price to book value is at a 14.63, which is above that 3.0 value, where value investors would consider it a value. But this is when you're looking at a company that's within the services and consumer goods, I would focus probably mainly more on the price of sales than a price to book. Price to book is important for financials and a couple other companies out there, but it's up to your opinion there. So current dividend yield is around a 1.83. Annualized payout is $1.92 per share each year. Their current payout ratio is at a 37%. They've grown their dividend for the past 55 years, having an average increase of 31.5% over the last 5 and 10%, or 5 or 10 years on average. So I took the average increase over the last 5 years, took the average increase over the last 10 years, added them together, divided it by 2, and I had an average increase there of 31.5. And that's not from 1963. This is just over the last 10 years. Number 3, we have ticker symbol FAST. This is Fastenal. They sell industrial and construction supplies. The company offers threaded fasteners such as bolts, nuts, screws, studs, and related washers, as well as miscellaneous other items here. The ex-dividend is on Tuesday, the 23rd of October, 2018. If you were to buy this stock on Monday or prior, you would be able to get paid out on the 21st of November. Here we can see their 10-year information. In the red, we have their free cash flow up 198%. In the blue, we have their price up 166%. In the green, we have their net income up 163%. And in the orange, we have their revenue up 106% over the past 10 years. So everything here, their price, their revenue, their free cash flow, their net income has had double-digit growth on average over the past 10 years. So, price 16% on average per year, free cash flow 19.8, net income 16.3, and revenue 10.6. So a very healthy looking company there. Fastenal, 1 year graph here, I'm taking a look. They currently pay out 40 cents per share. You can see there was a hike going into January. They let it settle. Then they had another hike here recently in May. So they increased their dividends somewhere down here in the 30-cent range to about 36 cents to now 40 cents per share each quarter. So very quick dividend raises there. They're currently priced at $52.66 with a current yield of now 3.04, which puts them way up in here. Their current PE is at a 20.49. Forward PE is at a 20.19. Price to book is at a 6.5 and a price to sales of 3.0 or 3.1. So when charted, it does show the current stock does have a higher yield of a price, which may indicate it could be undervalued at this time. The stock is trading above the industry average of 18.5. This was at a 20.49. It is sitting below the S&P 500 PE average of 22.46. It is also sitting below, it's actually above that payout ratio of 60%. So it's at a 62.5% payout ratio. Some people, there's lots of other companies out there that do have a higher payout ratio, but it's all up to the investor. Some investors, if you're investing, I believe Coca-Cola and Pepsi, they may have a higher PE payout ratio. But, if you're buying REITs and such, they generally have a higher payout ratio. This is all personal opinion, personal preference. If you do want to invest in a company that, this company overall has good, revenue, free cash flow, net income. So they do have some padding there. But it's all your guys' opinion there. So dividend growth the past 7 years, on average, increasing at 12.8% year over year since 2011. So what happened here back in 2011? They were paying out their dividend semi-annually. They decided to go ahead and take it quarterly. So they did end up switching to there, which did cause them to decrease their dividend payout because they cut it in half. They were doing 4 payouts instead of 2. So instead of paying out 20 cents per share, for example, they paid out 5 cents per share. Only they paid it out over 4 quarters. So they didn't have to pay out so much at a time. I think it was probably better for them during a downturn. They're like, hey, let's go ahead and keep some more of our capital in hand during these quarters instead of paying out one big chunk. And that probably helped them out there. Number 4, we have ticker symbol THO. This is Thorn Industries. They manufacture and sell recreational vehicles and small and mid-sized buses, as well as related parts and accessories. Their stock is going ex-dividend on the 24th of October, which is next Wednesday. You'd have to buy this stock on Tuesday or prior to be eligible for that payout on the 9th of November. Here in the green, we have their net income up 621% over the last 10 years. In the red, we have their free cash flow up 414%, their price up 308%, and in the orange, we have their revenue up 259%. So everything here, double-digit growth, plus it's in basically the 20 or higher range. So their price is up 30.8% on average per year over the last 10 years. You can see this huge fall going into 2018. Their price has gone nowhere but down. So if you're interested in taking a look at a stock that's fallen by roughly, that's a huge percent there. It's kind of interesting. They currently pay out 39 cents per share each quarter. They're currently priced at $81.15. This could be due to kind of, it has kind of like a support level since May. It did fall due to this current pullback that we've had recently, but it could be interesting. It could be a little bit worrisome there. Dividend yield is currently at a 1.92. Depending on the day, it looks like it just kind of came down pretty hard, so that kind of put that yield up at a 1.92, 1.82 range. Their current PE is at a 9.9. Forward PE is at a 9.3. Price to book is at a 2.2, and price to sales at a 0.5. So when charted, it does show the current stock does have a higher yield over price, which may indicate it could be undervalued at this time. The stock is trading below the industry average of 16.9 and below the S&P 500 average of 22.46. It is also sitting below that 60% payout ratio. It's at a 18.6% payout ratio and has had dividend growth for the past 8 years. Its price to book value is 2.2, which is below 3.0, where value investors would consider it a value. Check out that price to sales at 8.5. So current dividend yield right around that 1.92. They pay out $1.56 per share each year. Their current payout is roughly 18.6% per earnings per share. Their dividend growth is 8 years. Since 2010, they've raised their dividend on average 25.7% over the last 10 years. And they froze their dividend between 2006 and 2010. They just kind of locked it out. During that downturn, they saw that the economy was going into that downturn. They decided to lock out their dividend, and they didn't cut it. They didn't raise it. They just kind of locked it out at a healthy, dividend yield. Their stock continued to kind of climb, and you can see here during that downturn, it didn't really phase it. Most of these companies, they took a huge downturn during 08. This one had a bit of a dip there. It's had more of a dip here recently than it has in the past. Generally, it trades up very smoothly, but you can see it came back to correct itself. It had to correct itself. The normal trend line here for its 250-day moving average, it was trading way above it, and any investors that bought it at this point, they were just kind of buying it off of the win there. So interesting stock there. And the last one here, number 5, we have ticker symbol LKFN. This is Lakeland Financial. They provide commercial, retail, and investment management services. They also operate in 40 plus branches in northern Indiana. So this company is going ex-dividend on Wednesday, the 24th of October 2018. You'd have to buy this one on Tuesday or prior to be eligible for that payout date on the 5th of November. So here in the green, we have their net income up 234.6%, their price here in the blue up 232%, and their free cash flow up 231%, and their revenue up 110.5% over the last 10 years there. So taking a look at their price here, their price generally kind of trends up here. I would put this right about average. So if you took a line and kind of just scooted it all the way here, this would actually be a much better looking line than what happened during this time frame between, going in 2017 and current point. You can see the transition here. It smoothly goes here. And if you were to kind of just follow it along, you would probably see it more within this area that it's currently traded at now versus the hike that it had just over the last year and a half. So Lakeland Financials, they currently pay out 26 cents per share each quarter. They're currently priced at $44.64. That gives them a dividend yield around 2.33%. You can see they raised their dividend back in January timeframe from 22 cents per share to now 26 cents per share. The current PE is at a 17.44. Forward PE is at a 14.5. Their price to sales is at a 6.29, and price to book is at a 2.3. So when charted, it does show the current stock does have a higher yield over price, which may indicate it could be undervalued at this time. The stock is traded above the industry average of 14.4 and below the S&P 500 average of 22.46. It is sitting below that 60% payout ratio of 34%, and it's had dividend growth for the past 6 years. Its price to book value is at a 2.32, which is below that, or which is above. I'll have to change that, which is above that 3.0 value, where value investors would consider a value. The PE here is 17.44. Industry is 14.4 for the financial sector. Dividend yield, 2.33. They pay out $0.04 per share each year per share. Their current payout is 34%. They've raised their dividend over the last 6 years since 2012. They gave them an average increase of 12.8% over the last 5 and 10 years, on average. And during the downturn of 2008 through 2012, they did freeze their dividend. They didn't cut their dividend as many of those other financial institutions did. Financial institutions like JP Morgan, Goldman Sachs, they just flat out cut their dividends, not paying out shareholders. And this company here, they just froze out that dividend, continued to pay out their shareholders, making sure that nobody sold it off as hard as, we could check out here during the downturn. It did kind of suffer here for quite a while. You can see it back in their high here, probably 2008, 2009. It didn't fully recover to that point until probably right around 2013 or 2012, some in the time frame. So here during that downturn, you would have been able to average in during your position, and you would have locked in that yield. They didn't cut their dividend, but it would have been a really tough point to kind of continue to average in for a normal investor. So that is all I wanted to cover in today's video. So if you did like the article, if you did like the video, remember to share it, like it, give it a thumbs up button below, leave comments in the comment section below if you have any questions about anything that was covered in today's video. And of course, as a quick disclaimer, I am not a financial advisor, tax professional. The information provided is my opinion for entertainment and fun. This is just me as a financial investor trying to help others make their money work for them. So the 5 stocks again that we covered this week. Number 1, Apogee Enterprises. Number 2, we have Lowe's. Number 3, we have Fastenal. Number 4, we have Thorn Industries. And number 5, we have Lakeland Financial. In my opinion, it's a very tough choice, but as a dividend growth investor, if you're looking for one of the safest bets out there to invest in, although it is currently trading at a high price to yield, it could still be a good buying opportunity. Check out Lowe's. I think that would be a good buying opportunity. Or just check out any of these other ones. They haven't been paying out dividends. They haven't raised their dividends during the downturn, but many of them have either, this one, check it out. It switched from semi to quarterly, which is why they've only shown 7 years of dividend growth. But some of these other ones, instead of cutting it, they just froze it out. So would you feel pretty safe investing in a company that froze their dividend during downturns and just kind of, when they could raise their dividend again, raised it? But anyways, that is it for today's video. I hope you guys did like it. Again, if you are brand new to the channel, I do make stock market, personal finance, and real estate investment videos weekly, so consider subscribing for future videos. And thank you for tuning in. I will see you next time. Have a great day. Bye.